Hi, everyone. It's Darren. And today I'm joined with Eric Nuttall, Senior Portfolio Manager and Partner with 9 Point Partners in Toronto. And Eric, you actually have the distinction of running the world's top energy fund in 2021. And normally you're talking to CNBC and Bloomberg. So I appreciate you taking some time today to take us through the investment opportunities we're seeing in the oil and gas space. So thank you for your time today.
You bet. Happy to be with you.
Now, I know my clients will be quite surprised because I've generally stayed out of the oil and gas market for most of my 30-year career because generally it's a dirty business. I don't like it. I like businesses where companies are price setters as opposed to price takers. And the oil and gas business is very much a price taking business. Companies have to figure out how to make money depending on where the oil price is. Can I make money at $20? Can I make money at $80? But yet, I think you're showing us that we've really maybe seen a turn. And with you putting up a number of 180, what was your number? 186% return in 2021?
Yes.
Unbelievable. Have we missed it, or is there still more room for this trend to go?
Yeah, that's not an uncommon question to ask, right? Like, how can there possibly still be more upside in a sector that's had such a good run? And yet you need to reflect on the carnage that occurred in this sector during COVID, when many stocks fell by 70, 80, 90%, literally in a 2 to 3 month period, when there were lockdowns and complete uncertainty for how long the demand destruction was going to be. And so when we look at so much of the performance from last year was repairing what occurred in 2020. If you're not burdened by, having performed so strongly, if you're just looking at the opportunity set today, we're in a golden era of free cash flow for the industry, where companies are now prioritizing returning capital back to investors, as opposed to chasing growth and incinerating shareholder capital. That is exactly what occurred. And the reason why people like yourself who avoided the sector is the prudent call, because this has been a very tough sector to have been invested in for a while now. But the road that we're on is very different than the one we've been stuck on for that past decade for a couple of reasons. One, I see a case where demand will grow for the next at least 10 to 15 years. And yet there are structural constraints on growing supply, both within shale producers, within OPEC, and within the global super majors, where the meaningful growth and adequate growth in supply to match off that demand growth that I'm talking about is highly challenged. And so what I think we're in an environment of higher energy prices, higher oil prices. You're increasingly seeing calls of $100 oil, $115, $120, $130. The argument all revolves around the same key tenets, and that is demand is now back to pre-COVID levels. In fact, we're higher than where we were pre-COVID. So all of the damage from not flying and driving, etc., that's in the rearview mirror. What is sticking is U.S. shale growth, the era of them growing by so much that it creates a supply shock, is no more, because shale companies, we've seen examples this morning, they need to pay investors a quarterly variable dividend. And we're talking like 8, 9, 10% yields, very, very juicy. And so their ability to go spend what they did in the past is no more, because they have to satisfy a dividend. They can't go to the banks. Banks don't want to lend. The equity market remains closed. And so shale growth isn't going to grow as much as it had. Were it not for shale growth the past 10 years, non-OPEC production globally would have been flat, while demand had grown by 10 million barrels per day. And so the crisis that we are in today, we would have been in 10 years ago had it not been for U.S. shale. It deferred it. When we look at OPEC, we think OPEC will be exhausting its spare capacity by the fall time of this year, meaning that historical safety buffer of barrels that OPEC can easily bring on will be no more. And we're seeing that because 75% of OPEC countries right now are underproducing what they're allowed to under their deal. And so why is that? Why are they forsaking hundreds of millions of dollars? It's because they too have not sufficiently invested in what was a 6-7 year period of insufficient pricing, when they had to keep subsidizing power. They had to keep paying for free education, good government jobs. Otherwise, you violate that social contract with your populace, and they just don't vote you out. They go and revolting in the streets. And so you've seen lack of investment in OPEC. And then finally, the super majors, where investment from them peaked in 2014, corresponding with the peak in the oil price. Oil price crashes, investment crashes. And what's different there is that they're subjected to having to invest in long cycle production, meaning it just doesn't take 4 months or 6 months like a shale well to come on. It takes 4 to 6 years. And so as investment peaked in 2014, we're now 8 years, give or take, from that peak. all of the big projects that were sanctioned in an era of $100 oil, which was the 2010-2014 average, are no more. And so the super majors can't grow. OPEC's out of capacity. Shale will grow, but not nearly as much as it has in the past. And yet we're in this environment where demand, because of demographics and because of the timeline for alternatives to displace oil, like electric cars, hydrogen, everybody thinks, well, geez, oil is just used in cars and we're all going to be driving electric cars next year or two. The demand for oil is going to peak. The timeline for alternatives to displace oil is measured in decades. It's not measured in years, and it's certainly not measured in quarters. And
so let's touch on that for a second here, because I think you're right. Well, I think most people would appreciate that with the oil price being fairly low for a long time. And this is a classic supply-demand issue, I think. So supply has become very constrained. We're not seeing a lot of new exploration. Companies aren't out there. Now they've got, and it's very hard, as you say, for them to turn back on new capacity. So I think a lot of people would understand that. I think the one that's interesting that you're mentioning is this demand change, in that it's actually going up. Because I think most of us are watching TV and hearing about, well, we're all going to be driving electric cars soon. We're all going to have all these renewables and windmills and solar power, all this good green energy, and our demand for this nasty, dinosaur fuel is going to be going away. But it isn't, is it? And so you mentioned things like renewables taking a lot longer than people think. You also had mentioned in one of your notes to me about the population growth in emerging markets being a big driver of this too. Can you touch on a couple of those things? I think it's the demand side that's going to surprise people.
Yeah, I define this challenge as energy ignorance, and that is the lack of knowledge of how oil is used, for one, and two, what is the timeline for alternatives to displace it. So how is oil used? 60% is transportation, 40% is not. You touch on population growth. So that's the 40%, because we're talking things like lubricants, petrochemicals, plastics, agriculture, cement, all of these things for which there's really no alternatives. It's all about consumption. And so the world's population is going to grow by 2 billion people between now and 2050, when we're supposed to reach net zero. And it's not occurring in places like Canada. We have big immigration, 400,000 per year. So we're transplanting people because our indigenous population is not growing. Japan, United States. It's occurring in the Middle East, and it's occurring in Africa, where their living standard is not what we enjoy. And we enjoy a living standard that is hugely oil intensive. You and I both consume 20 barrels of oil a year. They in Africa and the Middle East consume 5. And so as the world's population is growing, and living standards in those areas where they only consume 5, but they want to consume 20, they want what we have, what we take for granted every single day, that 40% of oil consumption has to grow. The only way it can't is for you and I to tell those people, you can't have what we have. And that is not a conversation that's going to go over all that well. So that's 40%. The other 60 is transportation. And of that, about half are cars. And so let's talk about that, because people think, Tesla, we're not going to be using oil, and the end of oil is in sight, kind of thing. And so there are 1.3 billion internal combustion engines to displace, and EV sales globally last year were 5 million. So you've got 1.3 billion that's growing every year.
Right.
And last year we sold 5 million electric cars. And yeah, the 5 is going to grow and it's going to ramp, but it's taking decades for that 5 to scale to reach critical mass to be able to displace a meaningful amount of the 1.3, because that 1.3 is growing every year as the world's population grows. That's like the easy stuff. Electric cars is easy. We're ignoring things like, well, for every American to drive an electric car, they have to double the amount of power generation capabilities of the entire US, which sounds like a big enough feat, but then you're like, whoa, wait a second. They also want to decarbonize the existing power grid.
At the same time.
They have to go 4x. This is not something that happens in a year or two. And that assumes we have things like copper, when there's going to be a 32% copper deficit by the end of this decade. And so there's well-intentioned government policy, and that's what you hear about on CBC and mainstream media, who they are completely clueless. You've got well-intentioned government policy, and then you've got our energy reality. And there is a massive chasm between those two things. We have to live in reality eventually. We can't live in la la land forever. And so the energy realities are guardrails for speed of adoption, what we can ultimately achieve. And so the most aggressive estimate I've seen is, let's just forget reality. We'll hit every government policy, hydrogen, electric cars, all of these wonderful things. Demand still grows out to the mid 2030s, 2034, 2035, and then it just slowly starts to drop. Well, if companies today, because of the fear of peak demand, this line that the fear of peak demand is leading to the reality of peak supply, meaning the fear about, well, what does demand look like 7, 8, 9, 10, 11, 12, 13, 14 years from now? What does that mean? It's leading to lack of investment today. And you're seeing that from the super majors, where now that we've got ESG, they need to divest, they need to get out of dirty oil. We're going to take money out of dirty oil, put it into renewables, which are horrible businesses. So setting that aside. So we are very clearly in a supply crisis where demand will grow for years to come, and yet supply growth is hugely challenged. And the net result is oil is going to have to go high enough to kill discretionary demand. And we're talking about $140 oil. And so the opportunity for investors, and going back to your first question, have we missed it? Is there more upside?
Right.
Energy stocks today are discounting a $60 oil price. If we just believe in 80, forget 100, forget 120, 140. If we just believe in 80, the average company is trading at 2.9 times cash flow. They used to trade at 7 to 9. And the average Canadian energy company has 15 years of drilling inventory where they can keep production flat. And yet, because it's such an egregiously profitable business at 80, again, forgetting 90, forgetting at 100, the amount of free cash flow that industry generates, the entire sector could not just pay off all of their debt. They could buy back all of their shares outstanding with 5 years of free cash flow. So they have this 15-year annuity of free cash flow, and it would only take 5 of those to privatize and become debt-free, meaning as an investor, you're getting for free 10 years of free cash flow, which at $80, we're talking about a 26% free cash flow yield. So that's, undiscounted, that's a 260% return of free cash that companies can return, for which there is zero value being placed. And that's at an oil price $10 lower than where we sit today.
So that's amazing. So all these companies that had to figure out how to make money when oil was, $20 a barrel, that discipline has now allowed them to make enormous cash flow and profits now that oil is 50, 60, 80 and above. So I think this is very opportune. Now, your portfolio, is it a global one or is it mostly Canada? Take us through a little bit of just some of the positioning of how you run the thing.
Sure. Yeah, we can invest anywhere in the world. But where do we want to invest? We want to invest in Canada because our companies trade at the most discounted of almost any jurisdiction in the world. Like we trade at the same level as Russian AP stocks, and we don't have tanks just invading another country at the moment.
Right.
So yes, you can see our federal government may not be the biggest champion of this sector, and yet should the political risk discount be the same as those being placed on a country effectively a de facto war at the moment? I would say that's probably a little much. When we look at our companies, what do energy investors want? They want one thing only, that's returns. Dividends, buybacks. And so when you look at, as a company, what allows you to do that? You need low debt, you need long life reserves, you need low declines, meaning you don't have to spend as much to keep the treadmill going. You've got lots of free cash. And ideally, you want increasing customer diversification, you want more pipeline takeaway capacity. All of those things we have in Canada. And so there's speed bumps, TMX is going to be delayed by 9 months and whatever, but we'll have that on stream 2023, early 2024. But all of the positive rate of change, all of the attributes we want in a business that allows for maximum free cash flow, meaning maximum returns, we get that in Canada. And so, we do have a couple US names, but the majority of our focus is on Canada, small and mid cap, oily, and companies that are either returning capital back to us by meaningful buybacks or are on the cusp of doing that. So I'm really excited. We put up pretty good numbers last year. And yet when I think about my conviction in the macro backdrop for oil and how people are still so clueless, and hence why these energy stocks are trading the depressed and depressing valuations that they are, the risk that an investor is taking on relative to the reward that I can very easily quantify, there is such a mismatch, in my opinion, between those two things that even after a stellar year like last year, I'm still very, very excited about the potential upside that we have in our holdings. So we have names that, without getting too specific, we look for multi-bagger potential, and we still see that in the sector available to investors today.
No, it's a very interesting. And to me, the risk reward is the reverse of what we're seeing in a lot of the tech stocks, which are still priced, despite having being correctionary, are still priced almost to perfection. And a lot of things are, you have to bet a lot of things have to go right for a lot of those stocks to go back to just where they were. Whereas it looks to me like the oil and gas space, as you're managing it, is, as you say, the risk reward is fantastic for investors. The risk has almost gone out of that sector, and the upside is gigantic. So, listen, I'm gonna thank you for our 15 minutes today. I really appreciate your time. We've begun allocating in some of our models to your portfolio, and so now we're partners in this, and we're going to wish you all the best, Derek. So, thank you very much for your time. I really appreciate it.
Happy to spend the time with you.
Okay, thanks. And thank you all very much for watching. Hope you found this helpful. Any questions, reach out to us. And we're going to be running more of these interviews and things. So please be sure to like and subscribe. Thank you.